Okay, guys, welcome back to section 1, part 2, the basics of structure for trending traders. Okay, so I mentioned previously market fractality in the last video, right? I want to do a little bit of a deeper dive into what actual market fractality is. Okay, so we are going to go over to our charts over here. I'm going to give myself some room so I can actually give you guys a bit of a drawing. So again, we're going to go back to basic market structure, right? So we have our higher high, we have our lower high, we have our higher high, we have our lower high, we have our higher high, we have our lower high, we have our higher high. Okay? Within this market structure, right? So let's call this our 4-hour. This is our 4-hour structure. Okay? That's black. Now, what we're going to do is we're going to change our color here, and we're going to put in orange. Our orange is going to be, let's call it 30 minute. 30 minute. Right. You guys can't see that very well. Let's go with something a little different. Let's do red. Get dark red. Yeah, so this is going to be 30 min. Right. So this is our institutional order flow, right, based on our higher time frames. So our lower high, our high high, lower high, higher high, lower high, higher high, lower high, higher high. Right? We have our demand zones that have been put in, right? Now, let's remember demand zones always don't need to be met, right? So that liquidity doesn't always need to be taken. Eventually, at some point, that liquidity will be taken, right? But we're just doing this on a basic trend-based higher high, higher low system right now, right? So we have our breaks to the top side. Now, market fractality. What you'll see is you will start to see that if we are looking at a higher time frame, this is our 4-hour time frame. Within our 4-hour time frame, you are going to start to see this is what I mean by market fractality. You're going to see the same thing repeating on a lower time frame within higher time frame context, right? So what we're going to see here is we're going to see high high, high low, high high, high low, high high, high low, high low, high high, high low, high high, high low. This is what happens within our higher time frame market structure on a lower time frame, right? We have market structure showing on a lower time frame within higher time frame context, okay? Now, if we go even more, right? So now we're on the 30 minute. So let's do another color. Let's get a nice blue in here. And let's call this 1 minute structure. Okay, we have our 1 minute, right? That means that within here, you're gonna get higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and so on and so forth, right? So what we are trying to understand here is because we are going to be lower time frame based traders, right? And we're going to look for lower RR opportunities. What we want to do is we want to look for our opportunities on a lower time frame within higher time frame context, okay? So we have an understanding that if we are looking for some higher time frame bullish movement, right? Well, what we're probably going to look for is some type of accumulation opportunity on our entry time frame, which for us is not going to be 30 minutes. I'm just using this as an example, right? Because you don't want your time frames to be too extended from each other, right? But we are going to look for buys within these areas. Now there's a concept that I'm going to teach you guys later. It's called DCC, right? Really quickly, DCC is our direction. So we have bullish direction, we have our C, which is our correction, right? Which is our reaccumulation or accumulation of price, where price breaks down. And then we have a continuation, right? Now, DCCs happen all over the place. They happen from the highest time frame down to the lowest time frame. But what we're looking for is internal DCC within higher time frame confluence and market structure, right? So now that we know that we have our higher time frame market structure, we can be under the assumption that maybe price doesn't want to go below these demand zones, because institutional money will then be trading at a loss, right? So what institution's going to do is going to keep driving price up, and then we'll sell off into our demand and then drive price back up. So what we want to do is, because we're going to be lower time frame traders, we can look for direction, or we can look for opportunities in any direction, right? As long as the context is clear, as long as there's actual volume behind the delivery, and as long as we get some type of structure that isn't too choppy and it's easily tradable, right? So that's why I like to go down to the 15-second chart, which is where I take my entries, because we're going to get a lot of data, right? But we'll go over that later on. So what we're going to look for now, one thing that can happen is a lot of traders will start, they'll look for opportunities, it'll think it's going to keep going. They'll get messed up because price will start to accumulate downwards, and our lower time frames that we're looking at will start heading bearish, right? But what traders don't understand is that, well, yes, our time frame that we're currently looking at, because a lot of traders, if we're looking at a futures market, most likely are trading on the 1 minute chart below, or probably up to 5 minute chart. They will start getting all messed up, and they'll start going bearish here, 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 and they will start, the structure will then shift on them, because they don't understand that we are actually trading within higher time frame market structure still, right? But if you are a low enough time frame trader, you can look for opportunities going to the bearish side as well as to the bullish side, as long as our institutional order flow on our higher time frames lets us know that price most likely will not want to come below these areas, right? That's why we scalp trade. Let's look for some examples on our actual chart here. Right. Here. So we have our 4-hour time frame. We have our low, higher high, higher low, higher high. We have a break here, higher low, higher high, higher low, high high, and then we get a shift in direction, and traders will start to take this to the downside. But this leg here, right, is actually just an even higher time frame correction of price, right? So if we were to look at our daily chart from our 4-hour, looking at our circled area, this is just simply another area of liquidity, right, on a bullish trend. See, we have our low, our higher high. This is our institutional flow, right? We have a breakdown of price where we're getting lower highs, higher lows, right? We have a pause. We have a demand zone that's met here through the breakup structure up here. So we have demand created, and this is the area that I had showed you guys previously, right here. which is again just a small pullback within an even higher time frame accumulation, right? So the market is simply just this over and over and over again, right? So there's many time frames for you to look at. The higher time frames will show you the most accurate depiction of institutional order flow, right? But our job as traders is to understand that we can find opportunities all over the place, or we can find opportunities within the market within correct context. But we need to understand that a lot of the times when we are trading and we do see something like a reversal, or maybe price doesn't want to continue, it's simply because we are within the context of a higher time frame that is currently going through some type of correctional price, right? So again, I'll teach you a little bit later on our DCC model, right, which is our direction. D, this is our correction. C, and our continuation, which is our C. So direction, correction, continuation, right? We are looking for opportunities within our corrections. Okay, that's what I have for you guys right now. I will do a part 3 shortly.